Welcome, everyone. I'm Kristen Hochstein from Refinitiv, now part of London Stock Exchange Group, and I'm excited to moderate what should be a great dialogue discussing how we navigate shareholding disclosure requirements. Before we get started, please note that you can submit your questions via the Q&A box, so we'd love to keep this very engaging. I have with me today two fantastic speakers. First, a colleague of mine from Refinitiv, Janardan Yalapalli, who has been with the company since 2004, then Reuters, and he focuses on corporate actions collection, storage, and distribution, as well as shareholding disclosures. He has a proven track record across diversified projects, defining automation and operational improvements, and I look forward to his insights on the panel today. We also have Ebbe Filt, a true subject matter expert from FundApps, advising some of the most prominent asset managers and hedge funds on interpreting regulations and the critical compliance processes. Following his work across content to client services, he now supports the business development team on the FundApps platform, sharing his tremendous knowledge. So please join me in welcoming Janard and Ebbe. So first, we are going to consider the latest trends in investment management, and we're going to start with a poll question for the audience to get right into it. Have you experienced the number of disclosures growing, shrinking, or remaining the same? We'd love you to take a minute here and answer. And I think what we'll do is start with Janard. As you react to the question and as we get a few minutes for people to submit their responses, it would be great to get your view on the latest trends in the investment landscape that you are seeing. So I'll pass it over to you, Janard.
Thank you, Kirsten. Yeah, we observed, there's an increase in trend in investment, particularly from the people are shifting to, or returning to equity funds. And we also observed that there's almost like over 12,000 billion euros of asset under management, particularly in European fund industry itself. It also see that there's a trade volumes, so almost doubled over a period of time. That's what we are seeing in our real-time trade portals and all. And also observe that as a pandemic, as it has a lot of grip for 2019, 2020 and all. Now it started releasing it, and people are focusing on strengthening their financials and started investing. Or as a result, there's a lot of focus on their own financial planning, and it is resulting in investing in equities, funds, particularly equity-related funds, mutual funds, and hedge funds, and so on. We see an upward trend or uptick in the trade volumes as well as in the investment landscape. And this is all, dragging it to disclosure requirements as well.
Okay, let's give it just one more second, and I think we can see the results. All right. Janard, you want to react to what you're seeing on the screen?
Yes, this is not surprising me. The number of disclosures are increasing and growing, right? As I mentioned, there is a lot of investments are being made, a lot of trading is happening, and the trade volumes are doubling. And a lot of investment is being made into the exchange rate products, and equities, and hedge funds. These all are requiring or relating to the regulations to be followed or disclosure to be made, particularly with the 2015 November, the EU Transparency Directory made certain amendments which are dragging a lot of attention to the, scrutinizing the reports, which means there are a lot of other instruments like convertibles, derivatives, warrants, whose underlying is an equity and which is carrying an equal economic effect, are all are bringing under the shareholding disclosures. Plus, there's a lot of regulators do not have any patience in understanding when it comes to the errors for reporting. And if there is any, it's not in compliant, that drags, serious fines, potential loss of advisory services, and in some jurisdictions, it is considered as criminal offensive and imprisonment. All these factors are making or keeping the buy side and sell side investment banks like asset managers, hedge funds, and portfolio managers are being vigilant when it comes to the reporting. And they keep monitoring their positions. And whenever there's a change breaching the positions, they are stepping into and then reporting it. As a result, you see a lot of growth in reporting numbers. And this trend is seen predominantly post 2015, though these regulations are introduced somewhere decades back, but the trends are continuing it post 2015 with the amendment that they took place, and that's why you see this growth in reporting.
Yeah, that makes sense. Thank you so much, Shinard. How about we go to one more poll question before we move on? How concerned are you entering new markets and the lack of knowledge around disclosure requirements in new jurisdictions? Would you say you're extremely concerned, moderately concerned, slightly concerned, or not at all concerned? Let's give this a minute or so for the audience to enter their response here. Okay, we see responses coming in. We'll just give it about one more minute. All right, and the last second to answer before we publish the results. Okay, let's see the responses. All right, maybe get some reactions from our speakers on what we're seeing here.
Yeah, it is a concern. Sorry.
Go ahead. Sorry.
Yes, it is a concern when it comes to moderately and extremely to some extent, because the shareholding disclosures are global in nature and they are available for most of the global markets. But when it comes to the following, the interpretations and approach are not the same across the jurisdictions. Right? The reporting, they are unique in reporting. That means jurisdictions to jurisdiction, they keep changing. And frequency of reporting varies from jurisdictions to jurisdiction. Some may report T+1, or some might need to report T+2 basis, and they might need a lot of reference data attributes as well. So if someone wanted to, entering into the new market, there are several factors one need to consider, right? So one of them is, what is their investment portfolio? They need to thoroughly study the rules and understand whether they have the right level of data that exists with them for reporting the obligations, and which is spread across the jurisdictions. Two, they might need to determine which jurisdiction local rules that they need to follow for the given shareholding disclosures. That includes, where the issuer is incorporated, or where they are listed, or what is the chosen country as a home member state, just in case of European Union. Or if someone wanted to do it with the in-home reporting rules, they need to have a specialized team. At the same time, they need to have adequate tools and the data to make sure that their holdings are calculated appropriately and submitted. In all these scenarios, you need to have a good rule engine providers, and you need to have a good data provider who understand shareholding disclosures quite well. At the fag end, when entering into the market, right? It's the right information, and the timely and quality information is the key for regulations. Do you agree, Ed, on this?
Yeah, for sure. And I will be honest and say that I'm not super surprised to see people are concerned about this. This is also when we are approached now firm by prospects or potential clients looking for shareholding disclosure service, they come to us for a reason, and that is because the industry, also coming back to what you mentioned, the implementation of the transparency directive and the general higher complexity in these rules, the industry has woken up to the fact that this is something that, one, is not easy, and two, has severe consequences if you don't do it correctly. And taking this a little bit back, if I may, to the original question around the trends, and we see all these inflows coming into the equity-based funds, may they be derivative focused or whatever, there is equity at the bottom line. With this trend, all this additional money in the industry, it must be allocated in one way or the other. It can either be done on kind of adding more exposure to your already held investments, which of course increases your exposure there, which could make you trip over a threshold on issuers that you already held before this increase in AUM. But it could also be that you run out of, let's say, domestic investment opportunities. You outgrow your domestic market and you need to seek foreign investments. So investments in countries or jurisdictions that you're not too familiar with. So this is something that we see quite a lot, that you're forced into expansion and hence also forced into a new piece of regulation that you need to understand. You need to be aware of what assets are in scope. How do you determine whether an issue is disclosable in a new jurisdiction? And lastly, how do you calculate your exposure? So definitely agree with the first question as well, that the trends, we are seeing more and more disclosures being filed. What we see as well when we are approached and when we are talking to the industry about the concerns of shareholding disclosure, it is for a lot of different reasons that investors are concerned about this. And one of those things is just in general the extreme complexity held within these rules. And those nuance differences around each individual jurisdiction's rule set. And that can be on the asset classes. It can be on how to calculate your exposure. Is it based on shares outstanding? Is it based on total voting rights or something else? And lastly, also, how do you aggregate assets? And this is in particular a thing for larger organizations where we have a large corporate structure, a holding company at the top, and then multiple subsidiaries. Where do we aggregate our assets to? Is it to the top level, or does the requirement rest in other parts of these enterprises? And those rules, when you read through them in a piece of regulation, they're not always crystal clear, as you're also probably more than aware of. It is very gray area, a gray area zone here, where you need to make individual interpretations and then hope that is what the regulators want. And that's why we see needs for services like ours, and then also the data aspect to it. How do we get hold of all this data? So this is definitely not surprising to me.
Thank you, Ebbe, and thank you, Jannard. And given what you both have shared about the complexity, I'm happy to see that we don't have any audience members who are showing zero concern because I think everybody should have some level of concern around some of these challenges. So Ebbe, maybe we start with going through a general overview of shareholding disclosure rules and how to comply with the requirements. I think that would be very helpful for the audience.
Yeah, I can give like a brief introduction to shareholding disclosure in general for those that may not be too familiar with these rule sets. So basically what we're trying to determine here in the wonderful world of shareholding disclosure is that when we become substantial shareholders, and we'll get back to what that means, then we need to file a certain report or at least notify the country's regulatory authority, could also be the exchange or the issuer themselves, about this substantial position that we hold in a particular company. Then the regulation here across each of the jurisdictions have their own definition of what is a notifiable issuer in our jurisdiction. And as Jannard mentioned as well, that can be very, very different. Some jurisdictions, they deem a disclosable issuer to be based on whether it's listed in that country's jurisdiction. Doesn't have to be the issuer's main market, doesn't have to be the primary trading venue. It could be one single share listed on the Hong Kong Stock Exchange, for example, would deem the issuer in scope for the Hong Kong rules. Could also be the issuer is incorporated in a specific jurisdiction or registered under a certain paragraph of those of the laws in that country. So that's our first understanding, figuring out which issuers are disclosable in which jurisdictions. Second to that comes, well, in that jurisdiction where our issue is disclosable, how do we calculate our exposure? If we hold outright cash equity, then in certain cases we need to calculate how many shares or what percentage of the issuer's total outstanding shares do we actually hold. So a percentage calculation which we can then evaluate against the thresholds which requires a disclosure. In most jurisdictions, a broad rule of thumb is that mostly is applied to 5% threshold, meaning if I own 5% of another company, I need to disclose to the relevant regulator. Importantly here, to understand, and which I'm pretty sure we can also discuss a little bit later, is that one issuer doesn't belong to one jurisdiction. That's a very, very dangerous assumption to make, because shareholding disclosure at its core and nature is a global rule set. And that comes also with the fact that we see these trends. More and more money is going into these markets, and that doesn't just impact the investors, but also the share issuers. They want to put their shares up for sale in multiple markets to open up the ability to purchase them to a larger span of investors. So we see a lot of American and European issuers, for example, starting to list their shares on Asian exchanges as well. And via those additional listings and operations in foreign jurisdictions by the issuers makes them disclosable in potentially 2 or even 3 different jurisdictions at the same time. So this is an important aspect of shareholding disclosure to be aware of. And one of the fallacies we hear from the people we talk with is, well, we only invest in these 2 or 3 markets, so we're pretty good covered on our shareholding disclosures. Well, where your issuers and where you trade your securities doesn't matter too much for the purpose of this rule set here. There you really need to monitor the big picture around where the issuer operates and not just where you trade your shares. So, yeah. In regards to how to monitor these requirements here, well, then of course it does require a bit of work to do, and mainly because there are 2 or 3 steps here. First of all, you need to understand the rule set, and as we just talked about, these rules are complex and they're very, very different in each of the jurisdictions where this is relevant. So there needs to be an analysis going on. And secondly, you also need to have some machinery that can calculate, embed that regulation into the machines, and then calculate what is my exposure. And secondly, you need to understand what documentation to actually file. So what we're seeing with the increased complexity in the market is that more and more investors, they are moving into, let's say, outsourced solutions for this. It is very time consuming and very costly to monitor this via human resource, to be completely honest. Whereas there are software providers such as ourselves that has specialized in this area and have found what we think to be good ways to approach this issue that the industry faces.
Ebe, such great insight. And I think you're really laying out why it's so critical to do this right. I think this would be the perfect time for us to look at the actual how some of the audience is doing this today. So why don't we pull up the poll question? How do you currently monitor shareholding disclosure requirements? Are you doing it manually in Excel? Is it a homegrown system? Do you have third-party software, or are you not monitoring them today? And we'll give this a minute for the audience to answer. Okay, they're starting to come in, so maybe we'll give it one more minute for everybody to share this, because I think this will be very helpful to understand. Okay, maybe about 30 more seconds for those final responses. I see just a few trickling in, and I think we're about to stop the poll right now. Let's share the results. Okay. Ebe, your thoughts here? Surprised?
I would say a little bit yes and no. I would have expected in some kind of order for them to be fairly equal, to be honest. However, not in the I don't monitor them category, because that's a dangerous strategy to pursue, to put it in that way. And that's, of course, risky. We got to remember when we are talking about shareholding disclosure and these complex rules and the time it takes and all this stuff, we don't do it for no reason, because to just allude to that a little bit, the sanctions for non-compliance in this space can be fairly hefty. Of course, monetary fines are the most common thing to see. However, we do also see very large reputational fines, to put it that way, reputational damage, which is especially a risk for, let's say, smaller, new started hedge funds, etc. If you're marketing your fund and you get fined for missing your disclosure obligations, well, it's going to be difficult to finding additional investments if you spend your money on fines and you get that reputation. Lastly, also to mention, the most severe sanction is, of course, imprisonment, which I don't know if that has ever happened, but it is written in the rules. Right? So, yeah, exactly. So for the ones that don't monitor them, that is a gutsy strategy. There could, of course, be reasons for it. However, even though you may think I do not have a disclosure requirement, my investments are not large enough for these 5% thresholds or whatever it may be, it should be noted that we have a lot lower thresholds in many different jurisdictions. Also, when you're talking about takeover transactions, for example, we see disclosures as low as 1% of an issuer's outstanding shares. And when we are talking about short selling, then disclosures, as just published by ESMA, and that's also been a case for a long time now, or during the COVID pandemic, has been as low as 0.1% short exposure. So there is a requirement to monitor them, or you can find a reason to monitor them regardless of what investor you are. Okay, enough about that. Sorry for the tangent there.
Bart, anything before we go on to some of the challenges firms are facing? Anything you wanted to comment on for this?
Yeah, exactly. So I think this is a good overview of what we're also seeing, and where we are seeing that more people and more investors are starting to outsource this requirement to more specialized firms. where they can take the heavy lifting of the investor's shoulders, do the analysis of the regulation, and potentially provide algorithms that simply monitors these requirements for them. So this is a really good development. And I would expect if we come back in 1 or 2 years' time and have exactly the same webinar here, the third-party software category would probably be even more to the right-hand side. The manually in Excel, that is very, very, very gutsy to do, in my opinion. Excel, even though it's a lovely tool, it simply doesn't has the necessary complexity and flexibility built into it to monitor these requirements accurately, especially if you are broadening your investments across multiple jurisdictions and also across multiple asset classes in particular, such as index derivatives. SPACs are being a big thing in the United States at the moment. These types of investments are very difficult to monitor in Excel for shareholding disclosure purposes.
Okay, thank you, Abhay. Very interesting. Okay, maybe now what we'll do is go to another poll question as we begin to discuss the challenges that firms are facing in managing data and how to address them. So let's look at, what do you see as the largest challenge when it comes to data? We could pull up that poll question. Is it access to data, quality of data, or integration of data? And as you fill this out and answer this and we open up this poll, we purposely used largest because we know that these likely all have some challenge, some level of challenge for everybody on the call. So we're forcing a ranking here. So we'll give you a minute or two to answer. Okay, and we see people starting to vote, which is great. We'll give it a minute more. All right, the stragglers, 30 more seconds. Okay, and I think we can open up the results. Okay. Janar, do you want to weigh in here? Let's get your response and thoughts on this, and maybe then go into the overall obstacles that firms are facing.
Yeah. I mean, this seems more reasonable. For reporting reasons, you need to have a quality of the data. Absolutely. But any error, as Ed mentioned, it would lead to heavy fines, imprisonment, as mentioned, not happen, but it can, right, as per the rule book. But we'll have to pay a lot of money or reputational issues that come up. If there is an error or emission that happens when reporting is taking place. And access to data is absolutely, yes, access to data is also needed. But what are the different challenges when we're taking this into the account, right? Quality of the data and others. The basic understanding is, when in the industry, shares is a general term which is used, but what share tag need to be used for reporting? Would it be a listed share type, or is an outstanding, or is it issued share type? Because it's not the same for all the jurisdictions where the reporting is taking place. At the same time, there's a need for voting rights, because certain markets, the reporting is taking place and the total voting is at the organization level. And when these voting rates calculated at the organization level, the focus is not just on the listed instruments or the number of instruments which is issued to the public. There are other instruments which are issued but not listed. Sourcing the unlisted shares is a big challenge because there is no official source which is available to track it, most of the scenarios. Similarly, the voting rights for these unlisted instruments, they're not publicly available in most of the markets. You have to do a lot of research, a lot of analysis before you take that into account. Other thing is when we look at the share numbers, the share numbers are available in any of the places, any of the websites. But you need to pick the source to track the share numbers. And so for certain market, the regulator defines what the official source to be used for tracking the shares or voting rights. And so with the 2015 amendments, there's a lot of focuses on the instruments which are carrying the equal economic effect, which could be like convertible preference shares, convertible bonds into equity, or convertible instruments, derivative instruments, which is carrying underlying is an equity, which is having equal economic effect. They're also part of the disclosures, which means there is a lot of focus on additional reference data attributes that includes your convertible conversion ratios, the underlying for the conversions, and to identify the sensitive industries, you need to have a business classification codes and all, which is the key for or identifying if there is any sensitive industries where the disclosures are getting impacted. Identifying the home member state or European group, right? So you need to track this information absolutely which country the reporting has to be made. These are all some of the reference data attributes that are needed as part of the regulations. And how timely this data is tracked is very important. How timely the corporate actions are impacting on these shares information and how timely it is reported is very important. There's a delay also causes penalties. Right? And at the same time, when the data related to the issuers, you need to look at whether the issuer is in the takeover situation. If it is a takeover situation, then they may need to do an additional disclosures. At the same time, there are some markets like France or Belgium, issuer also sets certain threshold, and those thresholds are not publicly available. It has to go through the articles of association to track that information. Right. Similarly, markets like France, where there is a Florence Act. As per the Act, if someone is owning a share for more than 2 years, they are entitled to vote 2 votes per share. In such instances, tracking the total voting rights or total voting shares is not an easy task, because you have to track it from the respective source itself. In addition to that, there are certain markets where preference shares also carry the voting rights, and they are not given voting rights just like that, right? If there are certain clauses to be followed for that, if a preference stock is not paying any dividend over a period of time, let's say for 2 years, then they are entitled to vote. And wherever the total voting based thresholds are reported, they have to monitor and source this preference shares and its related voting rights also into account. And the other thing is the issue share capital. There are certain markets like Netherlands and other, they also wanted to see the reporting is based on the total issue share capital, where you need to track the face value of the security and the total number of the issued shares. You need to derive the total issued capital, and the reporting is done on that one. So like that, there are many challenges out there. But that you need to manage the data in such a way that you need to keep monitoring the sources that are available for you, and then track it in a timely manner with adequate tools in place so that adequate data quality is maintained. And with the timely and adequate data quality, data fields will give you accurate reporting.
Thank you, Janard. Ebe, is there more you want to add? I know we talked earlier about some of the challenges with new markets and Janard also just shared a little bit of those complexities, but maybe you could talk a little bit more about some of the complexities across, multiple jurisdictions and some of those challenges around disclosure obligations.
Yeah, definitely. If I may just add a quick note to the point on data, real quick, and the quality of data, then that's also what I would have expected, because there is so much data that needs to be gathered to monitor, for example, shareholding disclosure. And there are in certain cases where that data is difficult to find the most accurate version of. And to give our kind of take on how to approach that problem in a shareholding disclosure universe here is to basically use the fact that every single investor on the planet where these rules are relevant for, in theory, they need exactly the same number, right? There can only be one total outstanding shares for any given issuer. So what we have tried to do here is to create, or in FundApps world, is to create a community around this problem here. So basically, we help each other as investors, one, figuring out the correct interpretation of the rules, but also validating each other's data, given that we all need to use the same numbers at the end of the day. And that goes for both denominator data, but it could span into where shares are listed, which is a difficult data point to come across as well. So that's how we as an industry can help each other, both in regards to the data, in regards to the interpretation, and also remembering that compliance and shareholding disclosure, it is not an alpha generating function at the investors' offices. This is a burden, a task that has been given by the regulators, and we may as well help each other instead of doing this thing in isolation when we can solve it much more efficiently as a community, both in regards to interpretation and data. So I think I hope that's the way that the industry will see this going forward, where we become a community, and at the end of the day, we may be able to impact the regulators and have them provide the data that is needed to comply with these more and more complex rules. That's kind of what we're trying to promote with our business here. But yeah, of course, on the challenges with the new markets, I actually prepared a little diagram here just to make it a little bit easier, and to give like a decently simple example of some of these complexities that we see in the various parts of the world of shareholding disclosure, where we're focusing on, let's say, 3 different jurisdictions, and see, one, what are the differences between them, and also how do they potentially interact with each other. And the 3 jurisdictions that we're looking at here are the United States, and we have the European Union and the United Kingdom as well. I'll put that in that bracket also. So here we are following the Transparency Directive, so one rule set for the entire region, at least at the top line, and then Australia as well. So 3 fairly big markets where we do see differences. And some of the main differences here are around, well, what issuers are disclosable? What do we need to look out for in order to determine whether an issue is disclosable? In the United States, here we need to focus or disclose on all issuers which are registered pursuant to what's called Section 12 of the Securities and Exchange Act. Section 12 is typically given when an issuer chooses to list their stocks on what's called a U.S. national exchange, which there are 26 or 29 of, I can't remember. That's the typical way to get one of these registrations. However, there are other ways or other means to acquire it as well. So it's not it is just a very good approximation. In the European Union, in the UK as well, there the criteria for when you need to disclose a position in that region is based on where the issuer is listed and whether the issuer is listed on, in particular, a regulated market within one of the member states in the European Union. If an issuer is listed in multiple markets, then as Janar here alluded to, the issuer needs to choose their home member state, i.e., what are my regulatory authority for that share listing. And that's data that's extremely difficult to get your hands on. In Australia, we look at Australian incorporated companies, plus they need to have a listing in Australia. So those are some of the little nuanced differences. The thresholds as well, here we are looking at minimum thresholds. So 5%, as mentioned, is the typical one. You do see across the European Union member states that have chosen to what's called gold plate the rules under the Transparency Directive, which means to basically make their own interpretation and implement lower thresholds than the 5% standard set out in the directive. On the asset classes, also a big difference. In the European Union, you disclose every single asset class. Even though we are concerned with voting rights control in general, you still need to disclose cash-settled derivatives, so your cash-settled swap contracts, they are disclosable. You also need to disclose look-through positions, so if you do invest in index futures for hedging purposes or whatever, they are disclosable as well in terms of the underlying constituents. Australia, we disclose cash and physically settled derivatives across two separate regimes. United States, only equities and physically settled derivatives as well. So here, just to kind of get a little bit to the point, imagine the scenario where we do have an Australian issuer, so incorporated in Australia and listed on the Sydney Stock Exchange. That issuer will be disclosable in Australia, as everyone would potentially expect. However, it's not an uncommon scenario that issuer will choose to list its shares on the regulated market in Frankfurt to make them more available to the European investors on one of the liquid markets there. Already with that listing makes it disclosable to Germany or to the BaFin in Germany as well. If it wants to list depository receipts as being the easy way to attract US investors as well, that could require a Section 12 registration, and all of a sudden this Australian issuer is disclosable in all three regions. So this is where, again, an issuer can't be associated with a market. It needs to be associated with all markets in theory, and that's where, again, this rule set here lends itself to automation and very, very clever machines that understands these different nuances and can effectively identify them. Secondly to that, the documentation that needs to be filed in this space is, in certain cases, ridiculous. It's a large amount of paperwork that needs to be done, and something that can be very time-consuming and very prone to fat finger mistakes and errors in general, because they are just very difficult. So these are some of the kind of a brief overview and put into an example of why shareholding disclosure can be difficult and concerning for investors that goes into newer markets.
Ebbe, it's such a clean way to lay out the view, but then also emphasizes how nuanced it is, right? And difficult, because you get into all of these components, right? All of these differences as you go jurisdiction to jurisdiction. So I think this is terrific.
Yeah, and this is even just some of the simpler properties, some of the more black and white. It's a 5% or 3% threshold, where when you get into topics like aggregation, what happens if I delegate my securities to be managed by someone else, but I have the right to recall those securities and eliminate that delegation agreement? What happens then? Do I still have the requirement to disclose on them or not? And that differs. In Germany, you need to disclose on them. In the United States, if you can terminate that contract with with the delegator, so the third-party manager, within 60 days, you need to disclose on them still, because they will essentially just be another derivative position where you can get access to the shares within this 60-day window. And these are all the nuances where I personally have trawled through tens and tens thousands of pages of disclosure documents, and that's of course very time consuming.
A lot of work. All right, so we see some questions coming in, and as a reminder, please enter your questions in the chat if you haven't seen where to do that. I see one here that's asking, How do you overcome the challenge of identifying which markets an issuer is listed in?
Yeah, I
Either
can
one of
give
you
it.
want to take that? Maybe start with you, Ebe. Continuation of the conversation.
Yeah, what we have found to be kind of the most efficient way and that's in general with data challenges, is to leverage each other's expertise. So figure out this information is available somewhere. And the larger this, let's say, compliance community gets, the higher probability there will be of someone having picked up on what are the actual listings of this issuer here. And this is also data that changes more frequently than many would probably imagine, due to these temporary broker listings that many issuers choose to engage with. So we have found that a community approach is typically the best, and then of course using the most reliable data vendor that has the resource to really dig deep into these issuers and understand their corporate actions, etc.
Gennard, this seems like a great question for you to weigh in as well.
Yes, if I see from a Refinitiv side of it also, right, there is if an instrument is issued, it gets listed in multiple stock exchanges or multiple venues, and we source all of that information, and it is made available for the user. So if you put one instrument which is listed in several venues, you get to see all the exchange codes where it is listed. So maybe that can be leveraged while reporting or while calculating their positions for and reporting as part of the shareholding disclosure.
Thank you. And actually, there's a follow-up asking whether that community approach, Ebe, to identifying markets is incorporated into FundApps.
Yeah, so currently we leverage this community feature automatically on all the denominator properties, so shares outstanding and voting rights, class shares outstanding, all these types of properties, which is it's a simpler lookup basically. However, and this is fully functional this day and something that everyone benefits from. On the market side, it's not something we have developed yet there, but it's definitely a direction we're looking to take this feature into, basically across all data properties where there is a demand and need for it, and where the data is difficult to get.
And I like this provocative question on the debate of community approach versus expertise of a vendor. So someone asked, wouldn't a data vendor like Refinitiv or Bloomberg or others trump a community approach to the usage of data points, especially when considering internal business requirements? So Gennard, why don't you weigh in on that question about using a data vendor?
Yeah. I
guess the question around either using multiple sources or a community approach, which would look at the differences versus one independent view that's done the research and collection, and you have that trusted source.
See, when it comes to the sourcing and the data, there is a due diligence is performed before considering a particular one as a source. And that is done not for a 1 month period or 2 months period. It's done over a period of like 3 to 4 months, and see whether the data which is coming is accurate, timely, and complete. Is all these key factors are very important when we are getting it. At the same time, it's not just depending on one source. It would be depending on multiple sources to ensure that we are getting right amount of information at the right time with the right quality. So some of the sources what we use, maybe Bloomberg is also going to be using it, but maybe they have their own systems in place while collecting it, and our systems are in place to ensure that we are getting right information, particularly to meet these kind of regulatory reporting related stuff.
Yeah, it comes down to often the independence and auditability, which give that added level of trust. There is a specific question, and I just have to say, terrific engagement from the audience, lots of questions coming in. What is the coverage of French articles of incorporation and also Euro home member state data? So a very specific question here, if somebody wanted to weigh in or could weigh in on that one.
Yeah, I can, I guess it's directed towards our platform potentially, but yeah, so on the French bylaws in Belgium, where they're typically seeing these additionally imposed limits. So again, we cover in our system roughly 600 of them globally. They are mainly in France and Belgium, but we also do see them in other jurisdictions from other issuers. We maintain them, we ensure that they are up to date. But again, here, a community or a crowdsourced approach can be taken when everyone is using the same platform, right? If there is a limit that we do not cover, we do not have available, and a client raises their hand and say, hey, FundApps, can you add this to your data repository? Sure. And then everyone benefits from it from that point in time. So that is, again, a strength with this crowdsourced version. And also just to add a quick comment to before, this community model, of course, it doesn't replace your data vendor. I see that more as an add-on to the data space. And the reason being that we see so much data, there is so much data out there, and in certain cases, the issuers are not even updating their own sources for finding this information. And in those cases where where an updated share capital is not reflected on the internet, well, how would anyone know that there has been this change, right? Not even Bloomberg, Refinitiv, FactSet, or FundApps, no one would be able to know. But an investor may have called up the investor relations and have access to this data, and that's how that can be fed back into the community model. So it's definitely not meant to start an argument here at all. It's definitely two complementary things, in my opinion.
Okay. Another question, just going, I think we've gone very detailed. Now a question about culture. Companies are dealing with the virtual and return to office hybrid environment, ensuring the right governance model may be trickier than ever. Can you speak to how this is affecting what already is a challenging environment around reporting disclosures? So there are some thoughts from either of you on that one as well.
Yeah, I have a few thoughts on that. Definitely, well, first of all, it's nice to be back to a semi-new, back to the old normal again, and that of course also means that the train is rolling and projects are set in motion again. One thing we did see over this lockdown here and with the pandemic in general was the authorities' ability to make changes to these regulatory thresholds extremely fast, and where the deadline for implementation were, well, next time you wake up from your sleep, you need to comply with a much lower threshold. That has put an urgency on figuring out, figuring out your controls. There has been put a lot more pressure on the controls you have in place for these types of functions, given how fast they can change. And we just witnessed that. So I think when we are returning and new projects are set in motion and there is a lot more collaboration amongst teams and more talk potentially, I think shareholding disclosure and regulatory reporting as a larger space within compliance will still see a lot of attention, given the potential for very sudden changes that unleashes a whole bunch of unexpected requirements overnight potentially. So That's kind of my take on that.
Thank you, Ebe. With 3 minutes left, I see two more questions that have come in. One of them is, are you using ESMA for host member state data, and what is your confidence with this data source? Janard, do you want to weigh in there quickly, or Ebe?
Yeah, for home member state purposes, so we will be using, there are two competent authorities we are using. One is FCA for UK related, another one is ESMA for other European related. And we get this data directly from the ESMA and FCA, and which is somewhat more reliable. So that's our confidence level.
Okay. And confidence in the data was the follow-up question. As a source, do you want to comment on that, Janard? I mean, we're pulling directly from.
Yes, we source this information directly from ESMA and FCA, and I think, when the data is getting into our system, there's a due diligence is performed. When if something is suspicious, we query them back, or we request the details back to them, ensure that we get the right amount of information.
Okay, great.
It was one of those things where this database, which has been called many names, and with its launch with the MiFID II implementation back in 2018, it was the data quality was questionable. And based on our conversations with ESMA and the regulators, it was because the responsibility to update this data hadn't found its place. It was not with ESMA. The regulators didn't want to take responsibility, etc. So that has luckily changed since its implementation, and now our thoughts around it is that the data quality there is actually pretty good. And then also remember that the home member state for most issuers is just where they're incorporated.
Okay, terrific. And the last question is, can you touch on how to determine an industry on sensitive industry rules? There are a number of classification codes out there, all with limited coverage. Do you recommend a hierarchy or scoping in a number of codes into monitoring?
Yeah, that's a difficult one. If I can just take the first stab, because one thing is how the rules around this is written, how industries are defined, and then what standard classifications are available, whether that's the gig classification or something else. They are not a one-to-one mapping, which is why this is a very difficult space to navigate in, because at some point you need to make a judgment call and saying, well, I'm only going to go 2 levels deep into the gig code classification system and pick whichever one I deem to be the best one. But it will always be a judgment call. But I'm interested to hear what Janard thinks about this.
Yeah, 30 seconds, Janard. Final thoughts on that?
Yes, I would echo with you, Eb. We need to see, in our data world, we have TRBC, business classification codes, and gigs as well, which gives the hierarchy, and it all depending on how you interpret the data and how you take it for your regulatory reasons. So gigs and TRBC codes are quite helpful in identifying sensitive industries based on the need that you have it. And again, you'll have to do some kind of research before finalizing the respective course.
Okay. Well, we are at the top of the hour. So before everybody leaves, I'm just going to also ask that a survey will pop up. And if you could take even just a minute or so to fill it out, we'll greatly appreciate it. But I want to, in addition to thanking our wonderful speakers, the audience has been tremendous. So we appreciate all of the responses and the questions, and we thank everyone. And we hope you enjoyed it as much as we did. Have a wonderful day.
Thank you.